Good morning. Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, how does a solo 401k work for a sole proprietor? This is also your chance to get answers. Use the chat to ask questions on today's topic or any other matter surrounding solo 401k plans, as well as self-directed IRAs. Make sure to type them over so that we can be sure to get to them. We will pause and answer questions as they come in. So if you are a sole proprietor filing a Schedule C with your personal Form 1040 tax return, then a solo 401k, also called a one participant 401k, can be one of the most powerful retirement tools available. A solo 401k allows you to contribute both as an employee and as an employer. This dual contribution structure is what makes the solo 401k so powerful for self-employed sole proprietorship business owners. What is a solo 401k? A solo 401k is a qualified retirement plan designed for self-employed individuals. Your self-employed business can be an S corporation, partnership, sole proprietorship, or an LLC taxed of any of the above. Today, we are covering how it applies to a sole proprietorship. We have performed other webinars in the past regarding how a solo 401k plan works for an S corporation and a partnership, for example, and you can access those past live webinars by visiting our YouTube channel. And if you subscribe to our YouTube channel, you will also receive notifications regarding when we go live, and you can also access past webinars. So in the context of a sole proprietorship, again, a solo 401k is a qualified retirement plan that can be designed for a sole proprietorship or an LLC tax of a sole proprietorship, for example. Other examples of sole proprietors would be independent contractors, consultants, and the solo 401k plan can also be utilized by the business owner's spouse if he or she also works in that business. So the solo 401k follows the same rules found in the Internal Revenue Code that applies to traditional 401ks, but without full ERISA testing requirements, because there are no common law employees. So from an eligibility perspective, to qualify for a solo 401k, your business cannot employ any non-owner full-time W-2 employees, defined as an individual who's over age 21, who works 1,000 hours or more in your business as a W-2 employee. If your business employs a non-owner W-2 employee who works those number of hours there, then you would not qualify to open a solo 401k plan. You can always exclude contractors from participating in your solo 401k. So if you're a sole proprietorship and you hire contractors in your business, besides yourself, obviously, then it doesn't matter how many hours those contractors work, you would still qualify for a solo 401k. Let's talk about how contributions work for a sole proprietorship self-employed business. So as a sole proprietor, your contributions are based on net Schedule C income, effectively line 31 of your Schedule C. That's the line that you use for your calculations. That's the starting figure for solo 401k annual contributions, whether employee, employer, or voluntary after-tax contributions. So once you know what Schedule C, line 31, which is the net schedule income found in that Schedule C, you then subtract 1/2 of self-employment income tax. In our solo 401k contribution calculator on our website can perform that calculation for you once you plug in line 31 of that Schedule C. So this net figure is commonly referred to as the net earnings from self-employment. So let's talk about making employee solo 401k contributions, also known as salary deferral. You can contribute up to the annual employee deferral limit for the year. For tax year 2025, that limit is 23,500. It increased to 24,500 for tax year 2026. So if you have enough line 31 Schedule C net self-employment income after you subtract 1/2 of self-employment income tax from that figure, the difference can be applied as a employee contribution. So again, 23,500 for 2025, 24,500 for tax year 2026. Of course, if you want to contribute for tax year 2025, and you already established your solo 401k plan, then you would base that contribution for 2025 on your line 31 Schedule C for tax year 2025. Same thing for 2026. You would base your 2026 contribution on line 31 of your Schedule C for 2026. The employee contributions can be applied as pre-tax employee contributions or as Roth solo 401k employee contributions, or you can even split them. You can contribute some as pre-tax, some as Roth. And then if you're age 50 or older, you can make a catch-up contribution, which is 7,500 for tax year 2025. And the catch-up amount increased to $500 to 8,000 for tax year 2026. There's also that super catch-up contribution amount for those who are age 60, 61, 62, or 63, which is $11,250. And it became available starting in 2025. So if you have enough net self-employment income, that is line 31 Schedule C for tax year 2025, and you meet those age requirements, you're going to be able to make catch-up contributions and even super catch-up contributions if you are age 60, 61, 62, or 63. And that super catch-up is available for both years, 2025 and 2026. Now, the solo 401k plan also allows for employer profit sharing contributions. And I see a question here. We'll get to that question here in a moment. So, employer contributions, also known as profit sharing contributions, it's 20%. With respect to how it's calculated, it's 20% of your line 31 Schedule C self-employment income after you subtract 1/2 of self-employment income tax. Then you multiply that figure by 20%. So sole proprietors use 20%, not 25%, to calculate that employer contribution. That 25% figure for calculating employer profit sharing contributions applies to S corporations and C corporation self-employed businesses. If your self-employed business is a sole proprietorship or partnership, or even if you have a Schedule F because you're a farmer, it's going to be 20%, not 25%. Now, You can also make voluntary after-tax solo 401k contributions. And we'll talk about that more in a little bit when we start talking about the mega backdoor Roth solo 401k, which is a very common feature of solo 401k plans. But the maximum overall contribution limit for the year consists of employee contributions, employer contributions, and voluntary after-tax solo 401k contributions. So the annual contribution limit cannot exceed the 415 limit. However, the catch-up contributions are on top of that 415 limit. The 415 limit is effectively the overall contribution that can be made for someone who's under age 50, which again is 70,000 for tax year 2025, and for tax year 2026, it increased by $2,000 to $72,000. So that doesn't include the catch-up contribution or the super catch-up contribution. Those super catch-up or catch-up contributions would be applied to the pre-tax solo 401k or the Roth solo 401k. It can never be applied to the voluntary after-tax solo 401k. Only overall contribution amounts. So, for example, if you wanted to make a voluntary after-tax solo 401k contribution for tax year 2025, the overall limit is $70,000, even if you're over age 50. Because you can never contribute the catch-up contribution to the voluntary after-tax solo 401k designated account. That instead has to flow either to the pre-tax solo 401k designated account or the Roth solo 401k designated account. Now, as far as, let's take a look at a question here, and then we'll talk about plan setup deadline. So the question is, I have an individual 401k at Schwab. What is the easiest way to set that up with my solo 401k? I would like to have the benefits of your plan and also have someone help manage the 5,500 easy process each year. I'm in a bit of a rush. I've recently liquidated my old 401k. So you definitely don't want to liquidate your solo 401k plan. So it's important to understand that you do not want to close your existing Schwab Solo 401k, because if you close it, that's going to result in having Schwab file a final 5,500 easy and issue a form 1099-R if you close that solo 401k plan. Instead, you want to do it as a restatement, where you change solo 401k plan providers, in this example from Charles Schwab to my solo 401k financial. When you process a restatement of a solo 401k, of an existing solo 401k, and you do it as a restatement, that's advantageous because it's not going to result in having to issue a final 5,500 easy or a form 1099-R to close the plan, because technically you're not closing the solo 401k plan. Instead, you're changing plan providers. So when you close the solo 401k, that's where you take a distribution or you transfer the funds out of the solo 401k plan to an IRA, for example. So those instances do trigger having to formally close the plan with the government, meaning you have to issue a final form 1099-R as well as a final form 5,500 easy. But a restatement is not considered a plan termination, so therefore you do not have to file a final 5,500 easy or a form 1099-R, and you don't want to because that'll create confusion with the government. But yes, we have many clients that have restated what we like to call their basic solo 401k from other providers, specifically brokerage firms, whether Fidelity or Schwab or E-Trade, for example. And that's allowed. And it happens quite often. We probably process a few restatements every day. Now back to Schwab specific, I'm going to share a link from our website that explains the how the restatement process works of a solo 401k that you have at Schwab already. By restating that to a solo 401k from my solo 401k financial. And as a matter of fact, you can even choose to continue to use Schwab for the new brokerage accounts for the self-directed solo 401k offered by my solo 401k financial, because Schwab will provide what they refer to as company retirement brokerage accounts for solo 401k plans offered by providers such as my solo 401k financial, whose plan has all the bells and whistles where you can perform the mega backdoor Roth solo 401k strategy, borrow from the solo 401k through a participant loan. It comes with the $1,500 auto contribution credit, where effectively the government is subsidizing the cost of opening and having a solo 401k for many years. We also take care of reporting for clients who timely request that service. For example, we'll handle Form 5500 Easy, Form 1099R reporting at no additional cost. That's covered in our annual fee. You just need to make sure you timely request that service, because we don't have access to our clients' funds. And that's one of the reasons our clients like to use our services, is that they get to choose where to hold their funds at. And we never have access to their funds, but we'll perform the ongoing compliance support, such as issuing Form 1099R if you ever take a distribution or if you process a conversion. It's very popular for the mega backdoor Roth solo 401k, for example. We'll issue a Form 1099R to report that mega backdoor Roth solo 401k conversion. We'll also prepare and file Form 5500 Easy, which applies once the fair market value of that solo 401k plan is greater than $250,000 as at the end of the plan year. So if the end of the plan year for your solo 401k is December 31st, and the market value is over 250,000 in value, where you add up all the balances in the plan, all the investments, then you would need to let us know to prepare that Form 5500 Easy. And you can do so easily by going to the Forms tab of our website, which can be located at the top right-hand corner of our website. And once you scroll down, there's a link where you can click on and you can submit the information for us to prepare that Form 5500 Easy for you. And again, we'll prepare it and file it electronically for you with the government. So hopefully that gives you some information about restating that existing solo 401k at Schwab. And now, if you decide to use Schwab for the new brokerage accounts, we'll prepare those new company retirement brokerage accounts for you, and also fax them to Schwab for you to open up those new brokerage accounts. And then we'll prepare an internal transfer form to have Schwab transfer their existing solo 401k internally, including any securities, so that you don't have to liquidate your securities. Those can all be transferred in kind to the new brokerage accounts at Schwab for the solo 401k that we offer. Schwab will not allow you to keep that existing Schwab solo 401k brokerage account, because that's for their solo 401k. If you're going to restate to a plan from a provider like my solo 401k financial. So new brokerage accounts would need to be established, and we would assist you in opening those new brokerage accounts at Schwab, as well as transferring those existing Schwab solo 401k funds and securities internally. Yes, you can complete our online application to get started with the restatement of that existing solo 401k at Schwab to a solo 401k offered by my solo 401k financial. I just shared that link to our opening page on our website there. So let's get back to our topic for today, but go ahead and keep typing over any questions you might have, and we'll pause and answer those questions as they come in. Now, let's talk a little bit about the solo 401k contribution deadlines and plan setup deadline as they apply to a sole proprietorship. So What's great about the Secure Act 2.0, as well as Secure Act 1.0, is that now for your sole proprietorship business, self-employed business, it's not too late to open a solo 401k plan in the current year so that you can make prior year solo 401k contributions. So let's spend a few minutes talking about that as it relates to a sole proprietorship. Let me pull up that slide. Give me a moment here. From a setup deadline for a solo 401k plan where the self-employed business is taxed as a sole proprietorship, a sole proprietorship can establish a solo 401k by the tax filing deadline, including extension for the prior year. For example, for tax year 2025, the plan can be established here in 2026, and it can be established as late as April 15 of 2026. Or if you file for a personal Form 1040 return extension, you're going to have until October 15 of 2026 to open the solo 401k plan to make prior year, that is tax year 2025 solo 401k contributions. However, there are some important limitations. So if you want to make employee contributions in the current year for the prior year, so here, if you want to make a contribution in 2026 as an employee contribution to that solo 401k for tax year 2025, then you need to open that solo 401k plan and make the contribution by April 15 of 2026. You can also make employer profit sharing contributions and voluntary after-tax solo 401k contributions for 2025 here in 2026 by April 15 of 2026. If you file for an extension instead, then you're going to have until October 15 of 2026 to open and fund that solo 401k plan for 2025 contributions. However, you will only be able to make voluntary after-tax solo 401k contributions, as well as voluntary after-tax solo 401k contributions by October 15 of year 2026 for 2025. And of course, you have to base it on your Schedule C, line 31 for 2025 with respect to the contributions. However, you will not be able to make employee solo 401k contributions after April 15 of 2026 for tax year 2025. So in short, if you open the solo 401k plan by April 15 of 2026 and make contributions, employee contributions specifically, you can do so for tax year 2025. If you wait to open it after April 15, but you open it by October 15 of 2026, you will not be able to make employee contributions, but you will be able to make employer contributions as well as voluntary after-tax solo 401k contributions. I know that's a lot of information to throw at you, but we've actually performed a live webinar on that specific deadline for sole proprietorships in the past. And you can actually access that live webinar by visiting our YouTube channel. Let's see if there are any questions right now. I don't see any questions, so we'll continue here. Now, if this information is helping you feel more confident about your future, whether you're listening to it live or a recording of it, we would really appreciate if you hit the like button on our YouTube channel, shares across the various social platforms. That's, of course, if you're liking the information. That'll help us get the word out to other solopreneurs. And you will also receive notifications regarding when we go live. And we typically go live once a day, oftentimes twice a day. For example, we will be going live again today for a second time here in a couple hours. Let's talk about, before we get to voluntary after-tax solo 401k contributions, let's see if we have any other topics to cover first. Let's go ahead and talk about making voluntary after-tax solo 401k contributions. This is actually, as I mentioned earlier, a very popular topic. So it makes sense to spend some time on this particular feature of the solo 401k plan that we offer here at my solo 401k financial. So can you make only voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth solo 401k strategy? Yes, you can, as long as your plan allows for it. Not all solo 401k plan providers provide a solo 401k plan that allows for the Mega Backdoor Roth solo 401k strategy. For example, traditional brokerage firms like Fidelity, Schwab, E-Trade, they do not allow for the Mega Backdoor Roth solo 401k strategy. However, they will provide brokerage accounts for a solo 401k offered by my solo 401k financial, because we allow you to hold your funds wherever you want, whether they can be held at Fidelity, Schwab, your local bank, for example. And the plan does allow for the Mega Backdoor Roth strategy, and we handle the reporting. So those banks or brokerage firms will happily offer holding accounts as part of the setup, because they know they're not responsible for the plan or the reporting. So a plan for my solo 401k financial does allow for the Mega Backdoor Roth strategy. So it's going to allow for voluntary after-tax contributions and planned Roth conversions to the Roth solo 401k, or conversions to a Roth IRA, because the Mega Backdoor Roth solo 401k strategy allows you to convert your voluntary after-tax solo 401k contributions to the Roth solo 401k or the Roth IRA. You get to choose. And being able to make voluntary after-tax solo 401k contributions and process conversions is the foundation of the Mega Backdoor Roth solo 401k strategy. So let's talk about let's give an example about the voluntary after-tax solo 401k strategy. So if your goal is to maximize Roth solo 401k funds, then that's why individuals use the Mega Backdoor Roth solo 401k strategy. It's a way to get more Roth funds into your retirement plan. So for example, if you want to maximize the voluntary after-tax solo 401k contribution for tax year 2025, it's not too late to open a solo 401k plan here in 2026, so that you can make tax year 2025 voluntary after-tax solo 401k contributions. You want to make sure you had enough net self-employment income for tax year 2025 to support that contribution, obviously. So you're going to be able to contribute that entire voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k holding account. So this holding account right here titled after tax. So if you had enough net self-employment income for tax year 2025, you can contribute the overall limit of $70,000 to the voluntary after-tax solo 401k, and then immediately convert it to the Roth solo 401k or to the Roth IRA. Then once you convert those funds to the Roth solo 401k or the Roth IRA, you would complete our online conversion form so that we collect the necessary information to issue that form 1099-R to report that backdoor Roth solo 401k conversion to the IRS. It's important to understand that if both spouses are self-employed in the same business, they can both participate in the same solo 401k plan, but they will each have separate holding accounts to hold their funds under the solo 401k plan because it's a defined contribution plan. Therefore, the IRS regulations require separate holding accounts, aka participant accounts for each participant, that is each spouse, and each source of funds, that is pre-tax, Roth, and voluntary after-tax funds under the solo 401k plan. So if you each have enough net self-employment income, you could each maximize that $70,000 solo 401k contribution for tax year 2025, for example, and increase by $2,000 to $72,000 for tax year 2026. And then you would both be able to convert, you each would be able to convert $70,000 of voluntary after-tax solo 401k contributions to the Roth solo 401k plan. So now you would end up with $140,000 in Roth solo 401k funds in that plan, $70,000 for each spouse. So that's how you really supercharge your household retirement savings. So again, you would contribute as the overall limit, excluding the catch-up, because catch-up contributions can never be applied to the voluntary after-tax solo 401k as part of the mega backdoor Roth. That would flow directly to the pre-tax solo 401k or the Roth solo 401k holding account. So this allows large Roth contributions beyond the standard Roth solo 401k contribution limits, as well as the Roth IRA limits. So why is this strategy so powerful for sole proprietorship self-employed businesses? Well, a sole proprietor has unique flexibility. You don't have a payroll requirement. You have full control over contributions and timing. So you can determine when you want to make the contributions, as long as it's done by the business tax return due date, plus timely filed extension. You get to choose the contribution types you want to make. You can make solely voluntary after-tax solo 401k contributions to maximize the mega backdoor Roth strategy. Of course, you don't get a tax deduction for that contribution, but the trade-off is that it gets converted to the Roth solo 401k or the Roth IRA. It'll grow tax-free. You can also make pre-tax contributions if you prefer, whether employee pre-tax or employer pre-tax. You can make employee contributions as pre-tax first, and then employer contributions as pre-tax second, and then the difference up to the overall limit as voluntary after-tax solo 401k contributions. So the takeaway is that you can break down the type of contributions you want to make, whether pre-tax Roth or voluntary after-tax. And what's great about the mega backdoor Roth solo 401k strategy is that unlike a backdoor Roth IRA, there is no pro rata rule that applies to mega backdoor Roth solo 401k conversions, meaning that mega backdoor Roth solo 401k conversions are not impacted by your existing IRAs, or even if you participate in a full-time employer 401k, or even if you have pre-tax funds in the solo 401k plan. That's why you have a separate holding account within the solo 401k plan to track the various contribution types. And one of those is a separate holding account for the voluntary after-tax solo 401k funds, which can then be converted as part of the mega backdoor Roth solo 401k strategy to the Roth solo 401k or the Roth IRA. So let's talk about some final takeaways here. So a solo 401k allows you to contribute as both an employee and as an employer. Contributions are going to be based on Schedule C, which is the net self-employment income line. If you're self-employed business, is taxes and sole proprietorship. The employer contribution portion is going to be 20% of your net self-employment income tax after you subtract 1/2 of self-employment income tax. And the solo 401k plan can be established by your tax filing deadline for prior year employer contributions. Again, each contribution has its own separate deadline, and we spent a good amount of time going over that, so take a look at that. Also, voluntary after-tax contributions are allowed, which enable the mega backdoor Roth Solo 401k strategy. And then, of course, catch-up contributions only apply if your plan allows for it. So make sure you open a Solo 401k plan with a provider like my Solo 401k Financial, whose plan allows for voluntary after-tax Solo 401k contributions as part of the mega backdoor Roth. So for sole proprietors, the Solo 401k is one of the most powerful retirement planning tools available because it offers high contribution limits, Roth flexibility, mega backdoor Roth capability, tax deduction opportunities by making both pre-tax employee and pre-tax employer contributions, as well as investment flexibility because you can invest the Solo 401k plan not only in traditional investments like stocks and exchange traded funds, but also alternative investments like rental properties, promissory notes, tax liens, physical precious metals, cryptocurrency, private equity, and so forth. And of course, the Solo 401k plan, unlike IRAs, allows you to borrow through a Solo 401k participant loan, where you can borrow 50% of your Solo 401k balance, not to exceed $50,000, and each participant can borrow separately under that Solo 401k plan based on their respective funds in the Solo 401k plan. For example, if both spouses are self-employed in the same business and they both have enough funds in the Solo 401k plan, they can each borrow up to $50,000 from that Solo 401k plan through Solo 401k participant loans, resulting in being able to borrow a total of $100,000 between both spouses. And the loan is paid back monthly or quarterly. Typically, it's a 5-year term consisting of principal and interest. However, if you borrow from the plan because you need to use those funds or want to use those funds towards the purchase of your primary residence, and that loan period is extended from 5 years to 15 or even 30 years. Okay, I think we've come to the end of our session here. So that's it for today's session. Thank you so much for investing your time with us. We know your time is valuable, but we think that these are beneficial for your retirement future. If you haven't yet, and you found this information helpful, we would appreciate it if you like and subscribe so that we can keep growing this community. And we'll be back here again in a few hours with more crucial content. Until then, have a good rest of the day.